Hi, everyone. Thank you very much for coming today. This is going to be so wonderful. We are so excited to hear from Parker. And Nika, would you please do an introduction?
Yeah, I'm very excited. Today we have Parker Pursell from the eRQP. We had another associate of his come and talk to us a while back when we first started this. But now also he deals with qualified funds, and he has a different way to set it up to have protections and benefits that he will explain to us right now.
And the first thing we'd love to hear is what an eRQP is. What do those initials stand for? Thank you
Sure.
for being here today.
Absolutely. Can everybody give me a thumbs up that can hear me? Y'all, is it clear? Okay, perfect. I'm testing out these new AirPods, so I appreciate y'all. So yeah, my name is Parker Pursell. I work with Damian Lupo in the eRQP company. There are some familiar faces in here, so it's good to see you all again. So yeah, Enhanced Qualified Retirement Plan. That's what the eRQP stands for. Do I have the ability to share my screen?
Yes, you do.
Okay. Perfect. Let's see here. Trying to see where the
If you can find your mute button, it'll be on the same band as that.
Yeah, it's I guess it's acting up on the share screen side. It's not allowing me to pull the. Let's see.
Try it again. I made you co-host.
Okay, let's try this again. And if I have to go audible here, I can do that as well. Try one more time.
You could also shoot it to me, and I could have it like up on my screen, I guess.
Okay.
And he's got plenty of room on his screen.
Yeah, and I got a doodad to actually show my screen through my camera, just in case the share screen doesn't end up working. It's like,
right.
We'll take that.
So what I'm going to do is I'm going to jump back out and jump back on because I had to change my preferences real quick. So y'all hang on for just a second, all right?
Okay.
Okay. All right, perfect. And here we go. All right, awesome. Thank y'all for your patience. Little technical difficulties, but this is the world we live in now. My direct role here is strategic partnership development. So what that means is I go into the void where the people are and really help tell the story of the eRQP company. A little bit about myself. I was born and raised on a farm about 45 minutes south here in Birmingham, Alabama. That's where a lot of my upbringing was taking place on a 3,200 acre property. We got a family business down there. So used to be in agriculture. Now we've shifted into hospitality, which is a little of kind of my background. I've got about 10 years in the customer service, coaching, development industry. Was actually in Atlanta yesterday at Chick-fil-A's headquarters doing some really unique vision casting for a couple projects that we're doing. So that was, you'll hear me talk about Chick-fil-A a lot. If you ever interact with me personally, it's just very near and dear to my professional upbringing. So this is a picture of my wife. We'll be married 7 years in May, and she is a fitness trainer here in Birmingham. We also found out that we are expecting our first child about a month ago. So this picture will be of 3 later this year. So super excited about that. So 3 things that really guide me are 3 values that I just live my life by, which is faith, relationship, and competition. So these 3 things is how I filter each day. If I get to engage in my faith, engage in meaningful relationships, and compete in some sort of way, then I've had a successful day. So I use this mantra, progress, not perfection, because what it does is gives me grace to fail, but also lets me look back and say, I'm a better version myself than I was yesterday. So I'm recently gotten into Ironman training, and I completed my first full back in September. But this is a picture of me finishing one up in New York back in July last year. So I just like to do hard stuff. It's fun. It's a little crazy, especially when I got into the full back in September. I was like 15 hours in. I'm like, what am I doing? But it was fun. So how I got here, responsibility to warn you hear that? On what was coming. Okay, sorry. There's a reverb going on in the background. So this is COVID, right? How I got here to the eRQP really is of no accident. I think it's really by accident that I ended up here. But when I was at the family business, COVID hit. We had some reorganization of our company, and I had to step out. I voluntarily stepped out into unemployment to go search and find some new learning opportunities, growth opportunities. I wanted to see what else was out there that I could learn to continue adding to my skill set. And for about 8 months, I pressure washed and came across this company here called the eRQP. A friend of mine said, "Hey, Parker, I think you really enjoy it. It's an entrepreneurial environment. We'd love for you to chat with our CEO." And I said, okay. Like, my first thought of it was, I'm going to have a sit down conversation with a guy in a suit and tie, and he's going to ask me for 3 people that I know for him to call after our meeting. Right. We've all had those conversations, but this was much different. And after he started talking, I really got this sense of this missional purpose of much of what you see here, right? It says William Wallace in Braveheart, and he embodies this picture of freedom, of liberation. And that's what our company exists to do, is really help liberate the minds and the limitations that people have on themselves when it comes to money and to finances. And what the eRQP is just a tool. So what this tool does is it helps eliminate and break people from financial bondage and break the shackles that hold them. So for us, we are on mission to free 1 million people. So 1 million people is small in comparison to maybe 300 million people in America, or the 3 point, whatever the world population number is today, right? But 1 million people is a movement, right? We see movements that happen. And when you get to 1 million people, like, it just is a waterfall effect at that point, right? And so for us, we want to make this thing, this mission, this movement, something that people like, and you all have probably had it in your own life, maybe include yourself. I know for me, when I had that light bulb moment of how I learned how a dollar actually worked and how I can use it to free me from all the stresses that come from, maybe not having money or whatever the case may be, it just was like, wow, there's so much to this that nobody ever taught me. And this company has taught me so much that now I want to share that with other people, right? And so for us, it's all on education. So we got to help people understand where their threats are. And so the biggest shackle holder out there is the IRS. Why? Because they're going to tax you over 70% of everything you make over the course of your lifetime. And that's a scary number. When you think about it, we're taxed all the way down to our income, our paycheck is taxed, or we're gassed on or we pay taxes on gas, on food, on sales tax. Like, all these different taxes are built in. And so the biggest question is, how do we get to zero? That's how the smart people do it, right? Like the Donald Trumps, all these individuals, the Elon Musk, wherever, they're trying to get to this zero. And so for us, we got to learn how to get there. For us to get there, we've got to think different. And then secondly, we've got to learn how to invest differently. So that's why we created the eRQP. So what the eRQP is what we like to call the Ferrari of 401ks. The reason we use the term Ferrari is because it's like a supercar, right? So for you, when you're driving a Honda, it's limited in some way when it comes to performance. And the eRQP it's a blend of the 401k section. So it's not, you'll hear people say, well, isn't it a solo 401k? It is in a sense, but it's also different in the fact that there are some unique features to it that make it much better than a solo 401k, primarily business owners, right? And we'll get into that in a minute. So why haven't you heard of this? Well, Wall Street, right? So Wall Street, really what they're out to do is take your money. They just want to fee you to death. They want to be able to pay for their country club memberships. They want to drive the really fancy cars and have you pay for it, right? So I'm not going to, get all over financial advisors and say every single one of them is bad, because they're not. But they're not going to tell you that there's another way to do it, or really empower you to go make some of these moves yourself. So that's why we put so much focus on education, and why the eQRP is important, especially during this day and age, is you have the ability to have a private checkbook for your control. You can fund deals in as little as 5 minutes. There's liability protection that's built inside of the plan, which we put in a Wyoming LLC that protects your assets as you're investing outside of the market. There's no UBIT tax, which we'll get into that in a minute. And then you also can have this as an individual, or if you have employees. There's different options as well that you can get into. And they're really limitless. These are just a few that mainly majority of people come to us and focus on, right? So real estate is one of the first ones, and probably one of the primary reasons people come to us. There's global options that you can get into. You can get into gold and silver and take physical possession of those. There's also Bitcoin and crypto, which I'm sure there's a lot of questions around that. It's very much an exploratory phase right now with the crypto markets, but I'm invested in it personally. I believe in it. I believe in where it's going. And so you can invest in it. You can physically hold the asset. You can hold it in these. So this is a digital wallet, but this is how you would hold your crypto assets. Traditionally, in an IRA, you would have to let somebody else control this, but you can have this yourself. So that's where people hold their crypto assets. So let's get into what the difference is between a self-directed IRA and an eQRP, and why this is important, especially when it comes to real estate. We're going to walk through a case study here in a second. So just a couple of differences I like to point out is that traditionally IRAs are slow because there's a custodian involved. Legally, the way they're set up is you have to have a financial or fiduciary custodian that's over your assets, and someone that basically gives the okay for you to make certain investments, right? With the eQRP, it's fast because it's set up for you to be the trustee. So it is a retirement savings trust. So what that means is there's this trust that you have with your retirement. You are the trustee to that. So thus you can act on behalf of the trust and invest where you want it to go. So you don't have to call anybody. You don't have to ask permission. You can just get into the deal super quick. Debt, this is a big deal, but debt is not your friend inside of an IRA. You're going to have this thing called UBIT tax hit. And then with eQRP, there's no UBIT tax. Debt is your friend. So you can use leverage to your advantage inside of this structure versus an IRA. And then the contribution limits are obviously much higher because there's a employer contribution or an employee contribution and an employer profit sharing side that you can take advantage of. And you can contribute essentially 10 times more into a plan like this than the traditional way through a self-directed IRA. So the deal that we'll talk through on why this UBIT tax and focusing on that zero number is important. This is one of the things that helps you get to zero and making sure you're doing it right. So we had this was a client of ours that got into a deal. There's a $50 million purchase. So 10 million was put in cash and 40 million was leveraged. 5 years later, they sold it for $100 million. So you took $100,000 from your IRA and doubled it, your investment. So your profit now is subjected to that UBIT tax because you invested through your IRA. So because, and we'll talk percentages here, because 80% was leveraged in the deal. So $10 million was put down in cash, $40 million was leveraged. So that's 80%. 80% now of those profits owe up to $30,000 in UBIT tax, which is you're going to pay up to 37% on those profits, and that's a nasty thing. So specifically, when you hear UBIT or UDFI, what it is unrelated business income tax that is triggered by unrelated debt financed income. So really the main walk away from here is you're going to pay taxes if you use an IRA and you have debt involved in the deal. Everybody's goal on this call is to not pay taxes, right? So remember that. You're going to pay taxes if you're using debt inside of an IRA. You're not if you're going to use a 401k. So you're looking at IRA investors paying up to $30,000. eRQP investors are paying nothing. So that's super important because we're exempt from that. And instead of giving that $30,000 to Uncle Sam, now you're just going to put that back into another syndication or another investment opportunity. And let's be real, who doesn't want to keep more money in their pocket? So if you're already invested with a self-directed IRA, is there hope for you? Absolutely. So there's a thing that's called an in-kind rollover. So if you're already invested in a few deals, doesn't matter how many, right? Before that deal matures and sells, you have the opportunity to move it over to a different structure and change that vehicle. Our team does all of this for you. So you don't have to worry about how it works or how to do it. We take care of all that. So what's called an in-kind rollover, we're changing the vehicle from a self-directed IRA to a 401k. And then now you're not going to pay that tax anymore because you've changed the vehicle, which is great. So let's talk about who's qualified real quick. 401ks have to have a stream of income that sponsors the plan. So just how many of y'all work W-2s? You raise your hand if you work a W-2. If not, that's fine. So the way W-2s work is if you have a stream of income that you're making from that company. Let's just say I'm working for Amazon. Amazon pays me a salary. So they have a 401k plan. And because I work for Amazon, those dollars that I earn, we'll call them Amazon dollars because that's how that money is recognized through my W-2. So if I'm going to put my dollars into a retirement plan, it has to come from the sponsor. So Amazon is a sponsor. It is paying me for work rendered so I can put it into the retirement plan. This works the same way. So I couldn't make money from Amazon and like a W-2 from Amazon and then put it in another 401k plan. The way the IRS lays it out is you have to be conducting business activity that subjects you to self-employment tax or payroll. So you don't have to have income to qualify. So I don't want you to walk away thinking, well, I don't have any money I'm making from a business, so I can't qualify. You don't have to. You just have to be conducting some type of activity that would subject you to being paid, right? So if you're a syndicator, self-employed, online businesses, I like to say side gigs. So if you've got like an LLC on the side, you're doing some consulting or online services, or it could be a number of things, you qualify. You can requalify passive income to reflect, self-employment income, which is your CPA can kind of help you walk through that. And if you're a W-2, that's fine, right? These side gigs that you do or this other business activity you have, you can qualify and participate in a plan like this. And then also, if you're a business owner and you have employees and you're looking for ways to self-direct your retirement, you can do it. There is no other plan out there in the United States that allows you to be a business owner with employees and self-direct your retirement. You may self-direct that other companies may say as well, you can pick some of these other stocks if you want to. That's not truly self-directing. Like if you have a company that's generating a lot of income and you're dumping a lot of money into the retirement plan, then why wouldn't you want to take advantage of that income and start putting it towards some of these alternative assets that you're already investing in, but you can make all the returns back tax-free or pay income taxes on it at a later date. So there's a lot of ways, especially people in real estate, I think, look at retirement plans like 401ks in a negative way. This is really just a tool to help you mitigate your tax liability and also generate some returns that you aren't going to find elsewhere, right? So real estate, we understand all the benefits that come from it, the depreciation, the cash flow, but if you've got a tax problem, retirement plans are great to dump money into to mitigate that. And then if you dump the money in the retirement plan, you don't have control of it, and it's just kind of sitting there, maybe in a stock market doing a little bit of work, then that's good, I guess, if you're okay making net 5% after fees, so on and so forth, market ups and downs. But if you could take that money and put it into alternative assets like real estate and some of these other private investments, private lending, I mean, you name it, I would think most people would want to do that, right?
So can I ask a couple questions?
Sure.
Because I'm not quite following, because
Okay.
I know a lot about IRAs and how they work, but I don't quite get how the QRP works. It looks like I could put any amount of money I want into that up to $67,000. Does my company have to make that kind of money, or me as a solo entrepreneur need to make that kind of money? What proof do I have to have that I could contribute $67,000 to a QRP? And you're saying it's avoiding, is it a Roth? Could it be a Roth? I'm not getting that part. So
I'm about to walk through that real quick. So there's two ways that you can put money into a retirement plan. You can do it through a rollover, or you can do it through a contribution. So rollovers, if you have old 401ks or old or traditional IRAs you want to move in, there is no limit to how much you can put in when it comes to money that's already sitting in another retirement vehicle.
Got it.
But with contributions, that comes from your business that's generating that income, right? So the deferrals that you put in are $20,500, and then there's a profit sharing component which allows you to hit up to that $67,000, and that's with the catch-up contributions added into it. So if you're over 50, you can put in up to $67,000. So what you would do is, let's just say you made $100,000 through your company, right? You can defer $20,500 in, and we're just going to arbitrarily kind of use even numbers to keep it simple. So now you've got $80,000 that you have remaining of your salary. So you can profit share 25% of that additionally into the plan of that 80,000, which would in theory give you, close to a little bit 40,000. So you got to earn, your income has to be higher to be able to maximize up to that limit, right? And you can have both deferred and Roth. There's just no income limits when it comes to your contributions. So if you're a high income earner, you can contribute up to that amount via Roth, which is great. We don't want to pay taxes if we don't have to, right? So you can do either or. So do you have another question?
I have several, so I'm waiting for you to get to the Q&A that we all love to have.
Okay. Yeah, I'll be there in a minute. So, really quickly, I kind of touched on the business owners. This is important to know because we can custom build plans for businesses that have employees. They're on a match or a deferral basis. We work with a group called SMA, Southern Medical Association, and they're our TPA providers on the back end. So the main point to take away with them is that they're basically going to keep your business compliant as you are self-directing your retirement, keep your employees compliant with their plans, do all the filings for them, take care of, make sure the contributions are going where they're supposed to go to each employee. Fees are fixed, which I think is great. So as a business owner, as you're anticipating the next year, most people don't know what they're paying with retirement when it comes to their own plan or with their business. They just kind of assume, well, I see money there. I see it kind of growing, but I couldn't tell you what exactly that number is. And sometimes they just choose not to know. It's self-directed. So much like the eQRP is this, like I said, is for business owners, and everything that I've been talking about applies the same. This is just for business owners. So you have the ability to have checkbook control. You've got the asset protection built in. You're not subject to that UBIT tax. and everybody's happy because now I think your employees get an opportunity to learn, if they choose, to self-direct their retirement. So it's a cool learning opportunity for them as well. Now, this is a unique situation that we had with a client of ours when we talk about utilizing kind of a specific situation, especially for you in real estate. So Susie, she's a dentist, and her husband, Sam, was a real estate professional. So they converted $300,000 of their eQRP to Roth. Now, what they did is they bought $1 million building, realized $300,000 in bonus depreciation for that year. So they had this event where they were going to pay income taxes, on $300,000. They took the bonus depreciation and then washed it even. So now they have $300,000 of their eQRP that is Roth, and they never paid taxes on it because they took their real estate professional status and took the bonus depreciation, offset the income tax they were going to pay on their retirement account, and didn't pay anything, right? So that's another unique way to take a retirement plan and use it to your advantage. And for their situation specifically, the real estate professional status just gives them some additional features to be able to do that. So that was a cool situation we got to help somebody with that I really think was valuable. There's also this component to the plan that not people don't think about. So if you have a business and you have kids, there's this component called K-Roth, which, let's just say, for all inclusive purposes, I've got a dental practice that I own, and I've got 3 small kids. This is a picture of Damien actually modeling as, I think he was modeling for JCPenney in this picture here, but you can pay your kids up to $12,000, or I think it's $12,500 now, this year's new limit. Take that as a write-off, right? And everything that you put into their plan for work rendered for your company that they do up till they're 18. So let's say they're 10 years old and you start paying them $12,500 each year for work rendered. That money is realized as Roth, and it's called a minor deduction. You can write that off on your personal taxes as well, but now they have a Roth account that they're growing. Once they hit 18, everything you're putting in there is basis. Okay. So let's say for 8 years, you put in, $12,500 each year. Now, let's say you get there and it's $90,000 that they have. They can take that out, the basis of it, they can take it out and use it for college, use it for whatever else they need, or they can just continue to keep investing it up until their retirement age. And now they have a Roth account that they've had since they were a kid growing, and they get to self-direct this retirement, in the way that they want to. So I think that's another really cool thing to utilize a tax advantage if you have kids in a business and are looking for unique ways to use them to help mitigate your tax liability, but also give them an opportunity to grow something tax-free until they get to the retirement age. And getting close to the end here, one thing I want to talk about too is when it comes to line of credit, you can use your retirement plan to borrow against. So people ask us, hey, can I use retirement to fund my own deal? Well, traditionally you can't, but there is a workaround to where you can take up to $50,000 or half the plan value, whichever is less. You can pull that money out. So the transaction of that deal specifically is looked at as a loan between you and your retirement plan. Now, whatever you do with that money, you can go invest it in a business. You can invest it in your own business. You can go buy a car with it. You just got to pay that money back to your plan over a 5-year basis, monthly or quarterly, at a ±1 prime interest rate, whatever you choose to do. So a lot of people utilize that option to go invest in assets they want to be active in, or a business they want to start. You name it, could be anything. But when you think about, going to the bank and applying for a loan, it's a very arduous process, and there's tons of paperwork, there's tons of friction. But with this, it's very simple because you can just go in, pull the money when you need it, pay it back over the terms that you set for yourself, on that 5-year basis, and then you're good to go. So that's another unique feature that is important to know. So
let's move on. We have a lot of people that have questions, and we'd like to get to that.
Okay.
And they could get all the details from you if they decide they want to move forward with this. That's all right. I have a plethora of questions because you brought up a lot of subjects so this is a retirement account. So nobody could take their money out before they're 59 and a half or 72. Is that correct?
59 and a half is when you can start pulling from retirement.
So you're putting a kid in that will never have use of their money until they're at retirement age. Is that correct then?
So anything you put in for them is considered basis, right? So what basis is, if any of y'all understand, if I contribute Roth dollars to an account, what I put in is basis, and I can pull it out at any time. But anything I make on top of that, the gains earned, I would not be able to touch theoretically until 59 and a half. You could pull it out if you want to. You're just going to pay a 10% penalty on that.
Well, that's the kind of interest that they would get. So that means they make zero. So that doesn't work. But how do you have a kid independently free by the time they're 30 is a question.
Is the interest still calculated on the basis, or when you pull that money out, does it calculate on the new remaining balance?
Say that one more time.
So if you pull out the basis, like what you were talking about, is the interest that's earned on the account based on what was put into it plus what it's accrued, or does it lose the basis once that's removed?
Yeah, so it's a good question that I'd have to get some clarity on, because the way I interpret it is it's based on what you pull out, right? And so whatever that new, I like to look at it as two, like my brain kind of works in a logical sense of what I put in, that's considered my basis, and that'll grow. So if I put 10,000 in and I've grown it to 25,000, I've got 15% that's earned on that 10,000, right? And if I went ahead and pulled that 10,000 out, I've got just the interest on that, what I've earned, right? So whatever I pull out of that, you're just going to be penalized with that 10%. You're not paying income taxes since it's Roth, right? It's just penalties. And, from there, you're just kind of keeping up with that basis and the interest earned off the basis. So it's a self-directed account, so there can be a little bit more math involved for you if you're keeping up with it. So you got to be organized as you're making these investments. But most people, we can get into the weeds too much here, but the reality is these retirement accounts are set up for a later date, right? And most people aren't going to pull it out unless there's a hardship or some immediate need they need it for. So I wouldn't focus too much on the weeds, I guess, because everybody's situations are different.
Well, I ask about that because different vehicles offer different ways of managing that. Some whole life policies, for example, you can pull money out and it maintains the interest based on the original basis, regardless of what's pulled out, up to a limit.
Yeah.
So I've got a gal who's gone through a divorce, and she is now finally getting her share of the, whatever you call that at the end of a divorce. And she wants to get it into something like a Roth, so she doesn't have to pay taxes on it for the interest it's going to earn. But she can't put the whole 100,000 in. And you said she has to make more money than what she contributes. Is that correct? Did I get that correct?
I'm not following the question.
She has to, so she has $100,000. She can't put the $100,000 in.
So, okay. So the money that she could put into the plan would have to be business income that she's earned, have to be earned income. The money from the divorce wouldn't be considered earned income.
Has to be earned income.
Correct.
You put that $100,000 into a whole life policy and then have access to it immediately and then be investing with it.
Exactly. That's what I was going to say.
Yeah, but she doesn't want to pay taxes on the money that's earned.
Well,
She doesn't have to in a whole life. There's no, it's tax deferred, and as long as it's assessed as loans, it's tax free.
That investment's going to go into something where she's going to earn 100% in 3 years. That will mean that 100,000 is now worth 200,000. She'll owe taxes on that 100,000 she earned. Correct? Because you can't put that back into the whole life tax free.
not all of it. Yeah.
But what she's earning in the policy is tax free. So
Yeah.
but, you know, when you pay taxes, that means you're making money. So taxes aren't always bad. It means you're making money.
I know, but she doesn't
minimize it as much as possible. But you know, when you can't, you don't want to just not make money because you don't want to pay taxes.
Yeah, I get that.
I think she might can think about diversifying it across a bunch of different stuff. You know.
Okay. Who else had some questions?
I mean, just listening to it overall, it sounds like a really good alternative to a self-directed IRA. It gives you a lot of advantages that you typically wouldn't get with a self-directed IRA. But I'm trying to understand some of the benefits of this over the Roth. But I guess one of the things is no custodian, so it's faster.
Mm-hmm.
No limitation, $7,000. You can do up to $67,000, right? Mm-hmm. Okay, so some of the limitations that you would have with a Roth go away here. Are there any disadvantages to this?
I'd say the biggest disadvantage is the greatest attribute of this plan, which is the fact that you have total control. And so if you aren't the most organized individual, or you're looking for somebody else to do the work for you, like think of us as guides. So I like to use metaphors. It's just how I communicate, but we picture our client like Luke Skywalker. He's the hero of the story. We're Yoda. Like we come along the journey with you. We help fight with you, but we can't actually defeat your nemesis or the thing that you're going for. You have to do it. So what our goal is to help elevate you, give you all the tools, the information, the education to be a smart self-directed investor and take as much friction out of the self-directed journey as possible that most people run into. It really happens when there's questions of simple things, right? Like, can I do this alternative investment? A lot of the other custodians out there, providers, aren't going to lean in to your actual situation because they really don't know. But for us, we've built our business model around understanding the 401k structure really well and answering. I mean, we're going to poke holes in your investment and ask you all sorts of things to make sure we're hearing it clearly and that you will give you the green light to say you can do this. We won't tell you that, oh, this is a really good deal, the returns are great. If you give us two options, we'll either say you can do both or you can do one. This one's disqualified. You got to choose which path you want to go down, though.
This sounds kind of like a hybrid between a solo 401k and a Roth.
So when you say you can have both inside this plan, you can have deferred pre-tax and Roth inside the eQRP. So they're synonymous.
Thank you. Marcy?
Yeah. Couple of things. You said that when you're working with this QR, whatever it is, I'm sorry.
QRP.
You mentioned that there is no interest and no penalty for withdrawing the monies. Is there are you saying that means that there's no specific withdrawal fee? Because, you know, if your money is in a retirement plan, or if it's with let's say it was rolled over into an insurance or securities group, a lot of times if you want to withdraw, there's if you're under 59 and a half, you would have to withdraw. You would have a penalty for withdrawing. The penalty would be applied to the amount that was withdrawn.
Right.
Yeah,
you said that you did have that.
Yeah. So, I mean, anytime you pull money out of a retirement plan early before 59 and a half, now, depending on what it is, right? If it's pre-tax dollars you're working with, you're going to pay income tax, and then you're going to pay the penalty on top of that. But if it's Roth dollars, now, if you're pulling it out as basis, you're not going to pay any penalties or taxes on it. But, based on kind of what we talked about earlier, if it was all Roth and you were pulling an amount greater than your basis with some interest earned on top of that, then you're going to pay just the 10% penalty on top of that. But for plans, you can move this. It's a tax and penalty free move to move money from one retirement vehicle to another retirement vehicle. If that's the question I think you're asking. So let's say you have an annuity, right, that's tied up and you've got 3 years left until maturation, then you would have to pay some penalties with pulling that annuity early. But if the annuity matured and you have access to pulling all that out, then you could move that over tax and penalty free. But that annuity penalty would only happen with that company if you violated the contract of that annuity that you originally set out with them, if that makes sense.
If you're are you talking about pulling out just a portion or the whole?
You can do partial rollovers or full rollovers. So if any of you had like an old 401k or traditional IRA with $1 million in it, you could say, I don't really want to pull everything out and take control of all this. I just want to take a portion. You absolutely can do a partial rollover. And we do that for people all the time. You just tell us what you want to pull out, and then we'll initiate that process with your firm to release those funds.
Are there any kinds of books, like corporate books or anything that you have to maintain? And if in your, when you roll them into your product, and if so, is there like a monthly maintenance fee?
Yeah. So for us, we will do all the filings for you each year. So any 1099-Rs, 5500s that need to be generated, we will never have access to your money. So that's how our business structure or our business model is built. So everything that comes from a charge standpoint, we charge on credit cards up front. Now, depending on your situation, if you're a business owner, there's some different fees involved. As an individual, you're looking at, anywhere from $495 a year to $895 a year, and it's fixed. So there is a setup fee involved for us to do all the work on the front end. And our service is premium because we have a full team here that's dedicated to servicing our clients. That's the reason that I'm able to get on here and educate you guys while we're able to, have these conversations on the phone for an hour at a time, because we want you to feel comfortable and confident in what you're doing. So there's no hidden fees, nickel and dimes. You know what you're going to be getting with us every year.
Well, you must have a fee.
Well, he did say that they have the fee. They have the setup fee, and which can be up at either $495 or $895. I would assume that the $895 is for a business. Is that correct? Okay.
Yeah. So our business, and this is where it'll get convoluted. Like if we have like individual conversations when it comes to your situation specific, we can talk through those, but it's going to vary for each individual business that's out there. So, throwing a bunch of numbers out there is just going to kind of get messy for people who may not be in those specific situations.
But I'm asking, is there a monthly?
No.
Okay.
There's just an annual each year, and that's it. So, I mean, you could split it out over 12 months if you wanted to think about it that way, but it's just once at a time.
When you set it up, there's a fee, and then there's an annual fee?
Correct. Yes.
Oh, that's the same as a monthly one, only it's just aggregated.
Yeah, however you want to look at it.
Okay.
Okay, thank you, Marcy. Nika?
Yeah, I have a question about, can you kind of get into the whole that the solo or the checkbook IRAs are becoming illegal and why it's not with you and what makes it that way with your company?
Yeah, so.
I know, that might be a long one.
No, it's fine. I see Chris in here. Hey, good to see you, Chris. We kind of talked about this last year. So what happened is last year Congress was trying to eliminate self-directed IRAs. Well, they took that off the chopping block, and I'm condensing this story to just relevant information. They took it off, and the tax courts ruled on a specific situation that happened with someone that had a self-directed checkbook controlled IRA. They acted in a disqualified manner where they possessed their precious metals personally, and that's disqualified because you have to have it vaulted elsewhere. So what the tax court saw as an opportunity to hit the self-directed IRA market and make it harder for people to control their money through a checkbook controlled LLC. So their solution is it's illegal for you to be the manager of that LLC through your IRA and also be the owner of the IRA. So what you would have to do is eliminate the checkbook controlled LLC completely and give it back to a custodian. So like a Equity Trust or Quest or Fidelity, whoever that may be, right? But their solution was, and this is terrible advice. So they said, or you can make your friend, you can make anyone but your parent, spouse, or child the manager of that LLC. So the people you trust most cannot be the manager of that LLC. You just got to give managerial control to somebody else. And I'm like, it's dumb,
No.
but that's like what they say the solution is. So the thing is with this, you don't have to worry about that. 401ks were not affected. It's just IRAs. And the whole reason around it, I'm not going to try to push like conspiracy theory type stuff, but you're looking at what's happening. IRAs are retail controlled, which means anybody that's making money can put money in it. And so politicians can affect the retailer driven market because they're going to send money back to Wall Street, which then Wall Street sends money back to the politicians. It's just this endless cycle for them to push money back into Wall Street. But with corporations, they don't want to necessarily mess with them near as much because they're the ones pushing the economy forward, right? So they don't want to touch these big dollar companies that are, dumping a lot of money as well into the stock market. But the self-directed 401k sector is so small that for them to do anything with it they wouldn't feel it. The self-directed IRA market has trillions of dollars tied up in it. So one small change can send a ton of money back into the market just because people are scared and don't know what to do.
Sadly. Cliff, any other questions?
Yes. So if I have a client that has a self-directed or not a self-directed, let's say an old employer-based 401k, and it's no longer active through an employer, can you move that into your product? And then if so, how long would it take?
Yeah, that's a great question, actually. Yes, you can. And it takes about 5 to 10 business days. It's really quick, to be quite honest, because we've built systems to go in and get the money out as quick as possible and do all the work for your client. So, the first questions that always asked is, well, how? It's like, you don't have to worry about the how because we're going to take care of that for you. We'll guide you. We'll let you know what's happening. But we're going to get you from point A to, Z before you know it. And then you're going to be making your investments and helping you initiate those investments, help you fill out paperwork if you need it. So, we're going to be here to support your client along the way.
I think Carlos Perez has a question. He's having trouble raising his hand.
Actually, I have 2 questions, if I may. The first one, you talk about the UBIT tax that could be imposed in some real estate investments that you do with your self-directed IRA. But if the money is in the Roth IRA, they should not be any taxes because it's good inside the Roth. Is that right?
You would think, but because it's in the IRA tax code, it's subject to that tax, no matter if it's Roth or if it's traditional.
No, it's not.
So, because I always understood that anything that is in the Roth, whatever happens in terms of growth, you will never be taxed on that money, even if you invested in gold or in the market or in real estate or whatever you invested on. They should not have any tax attached to that money. That account.
So
is that right?
There's no capital gains associated with it. So that is true. but that UBIT tax is associated with anything that has debt levied to it. Does that make sense?
No, I'm sorry. No, I'm not following.
So if there's no debt levied on it, then there's no UBIT?
Correct.
Got it. Okay.
Carlos, we can have a separate conversation about that.
Yeah. And then my second question is that you mentioned that you can contribute much more than you can contribute to your IRA account. Is that because it's categorized differently, like the Roth, for example, when you can only contribute, let's say, $7,000 a year, that you will be able to put money into this new account?
Yeah. So, I mean, the IRA and 401k sit in two separate tax codes. So there's different rules that apply to both. So you're limited with the IRA from a contribution standpoint, because that's just the limits they deem that you can put into a Roth IRA. But because the 401k structure is different, and with this one being supported as an employer in an employee sponsored plan, right? So you can, as the employee, if you're an individual, you can contribute up to $20,500. Then on top of that, you can profit share to yourself on the remainder of your salary, depending on how your business is set up, 20 to 25% of what's left over, which is why the contribution limits are so much higher. That's just what the 401k structure allows you to do. So there's really it's very black and white in the way that that's laid out. So
if you have, in my case, if I have a 401k from corporate, from my work already, is that possible to open a second 401k from my real estate business in my, and then contribute that separately?
Correct. You can. So you can have multiple 401ks, but the contribution limits are aggregate. So you can't max out, 10 401ks to the maximum limits. You just have that. Yep. You have that limit of what you can contribute to the 401k structure. And then you can do that through multiple streams of income if you have it. But people do set up, they have one at work, and then they also have their side business that they're generating income in. It just gives them that additional ability to mitigate their taxes as well, which I think is smart if you can do it.
Great. Thank you. Ramo?
So 3 questions real quick. So
because we're at the top of the hour already.
Okay. All right. So Parker, real quick. I can do something where I could do one for my day job, and I can do another eQRP that's my side hustle. Say I got 2 different side hustles. So I can have day job eQRP, I can have side hustle A eQRP, and side hustle B eQRP, correct?
So if I'm hearing you right, if you've got, let's just say you're an entrepreneur and you have 3 different businesses.
Correct.
If I'm hearing you correctly. Right. So I think
he's a W-2. Aren't you a W-2 for your daytime job, Rommel?
Yeah, for my daytime. And then you have the other 2 that are side hustles. Yeah.
So any money that you're earning from that W-2, do they have a retirement plan set up for you?
No, they do not.
So if you earn money from that company, any money that's earned from there, you would have to put into their retirement plan. You couldn't just arbitrarily put it into another one.
Okay.
So if you do have these other 2 side businesses, though, you can open up an eQRP. And kind of how I coach people is if you have 2 streams of income and you want to capture all of that, correct, I would create some entity under it to funnel both income streams to, and then have this be the sponsor of the plan, so you could capture all that income that you're earning to maximize your ability to contribute. So yeah. And I put my information on the right, so you all can schedule some time with me individually to ask more questions if you have it.
Yeah. So could he put those 2 together as one? Is there a particular reason that they would have to be separate, or funneled into one is kind of what you were saying, having like an LLC capture or oversee the 2 businesses? Does it make a difference?
So, I mean, it has to be sponsored by one. You can't have like 4 businesses in theory, like sponsored the one thing. That's why I'm saying if we're laying it out in levels, you could have business 1, business 2, 3, and 4, they're all earning income. And then they could just funnel to a pass through, like they all pay this company, and then you would pay yourself. So you could capture all that income up there. And you're giving yourself a bigger opportunity to like put away for your tax liability.
Hey, Parker, would this be the same as a series LLC if you set that up and then have that the money distributed to the separate accounts, something like that you're talking about?
Say that one more time. I didn't hear you clearly.
David?
A series LLC, are you familiar with that?
Not typically. So we don't set up those LLCs. Normally we defer to your accountant because they're going to have a broader scope of your financial situation. So we can help give you the how and then work with them on executing the how. So I don't want to appear as if I've got named like these letters after my name, because I don't, but we work through a lot of situations with people.
Now, are you saying that if you have 1, 2, 3, 4 businesses, but they're all in an LLC, then you could accomplish that, one sponsorship into the 401k. But if you have 4 different LLCs, you're going to have a little difficulty. Am I correct?
I mean, it's just all on how you pay yourself, right? So you could pay, the other units could flow to this other pass-through LLC. They could capture it, right? The income from those, what you would pay yourself or your business unit. And then you would pay yourself from the remainder unit that's captured all this income. So those questions are probably more geared for your CPA, because you've probably got a situation you're thinking through, and they're going to be able to look at your personal financial situation and give you the best advice on how to move forward with that. I'm speaking in arbitrary concepts here.
Okay. And Gary has a question.
Just real quick, because I know we're near the end here. When I had said there was income tax due, and I know it's a complicated situation, when you put money into a Roth, if you take it out before the right age, there is income tax due on a gain, I believe, if you're taking it out before 59 and a half or 72 or whatever the age is going to be, because I know they're thinking about raising that to 75 now. Am I correct on that, or it's something we can discuss afterwards?
Yeah, we can discuss it afterwards.
Okay.
Well, Parker, this has been most interesting, illuminating, and I think that there's quite a few people that are more curious about it, and I feel like I just misdirected someone into something. So you'll probably get a call from them, and I'll have to make amends to them. So thank you very, very, very much. I really appreciate it, and we'd love to have you come back again sometime.
All right. Thank you for your time, guys. I've got my information's on the right if you want to chat with me offline, but thanks again for your time. And Nika, thanks for inviting me, and Peggy, thank you as well, and hope to see you all soon.
Okay.